Now, here are your hosts, Dominic Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, March 14th, 2023. And I'm on, as always, with my partner, Dom Tavella. How are you?
Doing great, Mike. How are you?
I'm all right. So what's new?
What country are you in, Mike?
Oh, my God. It's been a wild weekend. It's never a good sign, Dominic, when I'm watching CNBC at 9 p.m. on a Sunday night and checking my phone for news alerts.
Look, we obviously, we've been expecting some volatility. We've talked about it for quite a few weeks, Mike, maybe even months. We thought these markets might come back and retest the low, but this bank failure out of California really threw a monkey wrench into the markets. 16th largest bank in the country, second largest default of a bank in the history of the country. So this was a significant event. And let's just say the markets acted as you would expect, right? A lot of volatility.
But you know what, Dom? Let's not forget that the Silicon Valley story was bubbling around Wednesday, Thursday, Friday, Sunday night. And I know Signature had a rough trading day on Friday, but I don't know if anyone saw Signature being closed down Sunday. I mean, to me, that was more of a shock than the SVB story.
Well, we sent out a video. I did an interview on Fox News on Saturday afternoon, Mike, and we sent out a video. By then, we knew that the bank was shut down. By then, the FDIC had already stepped in, and they were going to take over. What scared a lot of people was that the shareholders, the owners of the bank, you lost your money. You were done. What was unknown at that time was the depositors. There was a significant number of corporations and individuals that had deposits there, and normally you're only guaranteed up to $250,000, right? So how a company is going to make payroll this week if their money was frozen and maybe completely lost? And as you pointed out, the Fed announced Sunday night that they would be stepping in. I think it took a lot of pressure off the markets.
Oh, absolutely. And Janet Yellen, I think, was on one of the Sunday morning shows stating, we're not going to bail out these banks. And then technically they didn't, right? The shareholders got wiped out. The bondholders got hurt. The executives are gone. I don't want this to be a political statement, but I do think that the government did the right thing. The depositors didn't do anything wrong. They would have, as you said, it would have created havoc. And I think the stock market, which, has started to stabilize a little bit yesterday and today, especially, stock market would have been annihilated if this thing would have leaked into Monday. And we still,
Mike, and we saw it on Friday and even a little bit of it yesterday. The index that represents regional banks, I think at one point was down 28%. Because the question is, if this bank, and we do want to spend a minute because there were warnings out there, right? Mm-hmm. But if this bank was in trouble and eventually had to be taken over by the FDIC, how many other banks do we not know if there's a ticking time bomb inside? And that puts everything, the whole system in question, right? So I think that the government did the right thing by stepping in. There'll be political consequences, economic consequences, and we have a great guest tonight to help us with that. But for now, I think it was the right step. Protect the depositors, the shareholders. I'm sorry, Mike. You know what? You have a board, you have a management team there, you have oversight. Somebody should have known what was going on.
Right. I completely agree. And that was my point in bringing up Signature, right? Because the Silicon Valley story was bubbling around for a while, but if we would have opened up yesterday with two banks failing with no backstop, then we literally could have had a run on other regional banks. Customers calling up their accountant, their financial advisor, and what advice are we going to give? If you feel better not having to worry about it, because I don't know for sure which banks are going to go out and which ones no one knows, right?
Again, there's supposed to be oversight. There's supposed to be government agencies that look at this stuff. This was, I think, Silicon Valley was a little bit of a unique situation. At least I hope it was a little bit of a unique situation in that they had a significant number of value of their assets sitting in fixed maturity bonds. That 60%, Mike, was in fixed maturity long bonds. So when the run started, when people wanted to get their money out, they had to sell these bonds at a deep discount, take a huge loss. The loss amounted to over $2 billion. Mike, you and I know what it's like trying to sell blocks of stock or bonds on a Friday afternoon. Can you imagine this bank trying to sell $28 billion of bonds in one afternoon? They got hammered, right? So a lot of things went wrong. It was almost a perfect storm. I'm not sure if this exists with a lot of other banks, but it is an issue, and we all need to be aware of it.
Look, and the other part of it, and I'm glad you mentioned we have Jack Manley on tonight from J.P. Morgan Asset Management. And the other thing that I'm curious about, Dom, is the unintended consequence of a one-year treasury paying 5%. Is there has been an enormous amount of money, disintermediation, leaving bank deposits and going into treasuries. And and this was probably an unintended consequence of the Fed with the yield curve being inverted. But I also would think that one of the reasons the banks had to sell some of these older bonds is because it wasn't even a run on the bank. Just every day it was a drip of money leaving to buy short-term treasuries.
Well, again, I think Silicon was a little bit of a unique situation because their customer base, they had a significant amount of their customers that were in that technology space, crypto space, IPO space, venture capital. And we went through a period, Mike, of a year and a half where these firms normally would be collecting big dollars and making deposits. They actually were burning through their capital, trying to stay afloat and get these businesses off the ground. So this particular bank saw a large amount of outflows. There was a problem with these bonds in their portfolio. I don't know. I don't want to throw stones because I don't know the details, but clearly if Rick Reeder from Blackstone or Jeff Goodluck was there, some of the real premier bond money managers, maybe we would have seen a different story of how that portfolio was managed. And then when the whispers came out that the bank might be in trouble, they had $48 billion of assets come out over a 48-hour period, Mike. It was unsustainable. The whole thing was just a snowball going downhill.
You're right. And again, this is exactly why I think the government did the right thing on Sunday in preventing similar runs on the bank, whether the bank deserved it or not. Right.
And let's not let them completely off the hook here, Mike. It's their actions. It's the Fed's raising interest rates as aggressively as they have been that actually made those bonds worth less than they were a year and 2 years ago. Right. So it's this seesaw effect of higher interest rates. It's the Fed that raised interest rates that put the bank in that position.
That unintended consequence. I could not agree with you more. So tonight's guest, as I said, is Jack Manley from J.P. Morgan Asset Management. He's vice president there. He's a global market strategist. And we've asked him to come on tonight to shed some common sense light and to explain in language we could all understand, break down exactly what happened and other topics, Dom.
Looking forward to this, Mike.
So we'll be right back with Jack Manley right after this break.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner, Dominic Tavella, and our guest this evening, Jack Manley, Vice President of Global Market Strategist at J.P. Morgan Asset Management, our great friends and great supporters of our podcast. Good evening, Jack. How are you?
I'm doing well, Mike. How are you doing?
We're doing well.
Welcome, Jack.
Thanks, Dom. It's good to be here.
So, Jack, as I said on the open, I know you heard our conversation. Your timing tonight's perfect. We spent most of the year talking about interest rates and inflation, and it was starting to get a little redundant, kind of rehashing some of the same events. And then last week happened. And this is not 2008. I don't think it's a full-blown banking crisis. I don't think there's a contagion. I think the government did a good job in hopefully putting a lid on that. But your opinion is more important than ours. What's your view on what's going on?
I think what we've seen as a result of Silicon Valley Bank, and then to some extent a couple of these other names that have been in the news recently, is to the points that you guys were making earlier, kind of the unattended or unintended side effects or consequences of what has shaped up to be probably the most aggressive rate hiking cycle we've seen in 30 or 40 years. We spend a lot of time on the road talking about the impact of higher interest rates and what that means for consumers, what that means for business investment, what that means for mortgages. We don't really spend a whole lot of time talking about the potential for another banking crisis like what we saw back in 2008, because you look at the metrics that you would have looked at back then, and you say, hey, lending standards are pretty good. Credit quality is up. The consumer is doing okay. The financial system seems to be all right. And then all of a sudden, that saying is you never get hit by the train you're looking at. That's kind of what ended up happening here, right? And in retrospect, people should have been paying more attention to this. And if you did pay more attention to it, you probably would have seen it coming. But for now, I think it is just a pretty sobering reminder that there are some things going on beneath the surface that we may not be able to tell based off of sort of the traditional framework for analysis. But I'd agree with you, Mike. I think the government stepping in over the weekend, setting up some processes to not just backstop Silicon Valley Bank or Signature Bank, but also to set up a framework for support for any potential future bank that comes under pressure, did a whole lot to prevent the potential run on the banking system, and I think has sort of shored up a lot of the sentiment around this. I'll tell you, we're not speaking about it as much, even as much as we were yesterday or over the weekend. The sentiment's already calmed down a bit.
But isn't this literally, when we talk about unintended consequences, when money is zero interest rate, when or 1%, some nominal amount, and whether it's an individual has a home equity loan or a company that's borrowing on a variable rate, I mean, things look pretty good, right? But now that interest rates are starting to get to, and I dare say more in line, more normal rates, isn't this when some unfortunate things are going to pop up?
I think it's exactly the timing of that. And one of the problems that I've had sort of for the last 12, 13 months is that the Fed has been very intensely slamming on the brake and keeping their foot on the brake and not really giving this economy any real time to digest the impact of higher interest rates. When I think about the rate environment, whether it's applied to the equity market, the bond market, or even to something like what happened last week with balance sheets, it is not about the absolute level of interest rates, right? This economy can stomach a 5% Fed funds rate. The equity market can stomach a 5% Fed funds rate. I bet you if you gave Silicon Valley Bank enough time, they could have stomached the 5% Fed funds rate. The issue is the direction of travel and the rate of change. The fact that we are going from the cost of money, to your point, Don, being essentially nothing, to the cost of money now being quite tangible, and especially as inflation continues to come off the boil, the real cost of borrowing is getting pretty close to moving positive. Things are starting to break. This may not have been where we thought the break was going to happen. We probably would have assumed a slowdown in business investment, a slowdown in consumption, a tick up higher in the unemployment rate that actually meant something for the broader economy. But instead, something out of left field, right, that kind of shocked markets and sent jitters through sentiment.
So, Jack, I just want to hopefully you could help us crystallize what the government actually did Sunday night, because I spoke to so many clients in the last 24 hours that literally do not believe their own eyes and their own ears, right? So the government said that all depositors will be protected, every penny. They said the money is going to be used from the FDIC, and they said that it's not going to be any taxpayer money. Now, maybe it's just a complete distrust of the government and politicians in general, but did I get any of that fact pattern wrong, or is that pretty much spot on?
No, Mike, I mean, that is spot on. And I think the one thing I would add to that is the way the FDIC is going to be funding these backstops is by taxing other financial institutions that are members of the FDIC. This is socialism. I mean, we are socializing the losses of these banks around major financial institutions across the United States. So when we think about, does the taxpayer actually shoulder the burden of these backstops? It depends how pedantic you want to get, right? Because at the end of the day, look, our taxes aren't going to go up because of this directly. And at the end of the day, we're not going to see spending diverted from something else to go fix up SVB or to go fix up Signature Bank. But taxpayers are depositors at banks as well. And if all of a sudden, banks maybe cut the interest rate that they're going to lend to you or borrow from you on in order to help to pay for whatever may be happening, or you are a taxpayer that also happens to be the shareholder of one of these companies, and now their profits are going to take a modest dip because they have to kick into the pot that the FDIC has established, we're going to pay for this one way or another. I do think it is political to say that the taxpayer won't be paying for this, but I also would say that there is a clear distinction between what happened in the aftermath of 2008 and what is happening right now, and that is that at least directly the taxpayer is not on the hook.
And I'm sorry, Dominic. And,
No, go ahead, Mike.
And the executives of these banks are gone.
Gone. And
that
if you're
did
an
not
equity
happen.
holder,
Right.
gone.
Right.
And if you're a bond holder, look, you're in line, but we'll see what's left when the dust has settled on this one. So yeah, there aren't a whole lot of golden parachutes getting issued right now to the executives that help to take these companies in the wrong direction.
And the FDIC is trying to sell off the different modules of this bank, right? I know their wealth division is particularly valuable. They bought, I believe, Boston. Was it? Do you remember the name, Mike?
Yeah, they bought the European division or something like HSBC.
HSBC bought the UK version
Yeah.
of SVB. Yeah.
Yeah, so there are valuable pieces to this that hopefully they'll use to reimburse themselves for any outlay, any dollars they're going to spend to reimburse the depositors.
There is certainly value, I think, still to be found in Silicon Valley Bank. And frankly, I have seen some research, some analysis that says that if there hadn't been this sort of quick run on the institution, they would have been able to stomach these problems just fine. One of the interesting analyses that I read yesterday is that a Silicon Valley Bank deals with a very specific subset of client, which is going to be technology and tech adjacent sort of founders, VC firms, that kind of individual. Now, all of those individuals are very closely linked. They are a tight-knit group. They live on the internet and they act with herd mentality. Very, very different from a broader sort of retail deposit bank. I mean, if you were paying attention to Twitter on Thursday, Friday, Saturday, you could literally watch the bank run happen unfolding in front of your very eyes. SVB got caught off guard by the nature of their client base. And in fact, one of the executives there interviewed said that he would never have expected that one of the biggest problems with their business model is that they targeted this specific type of individual that likes to move in waves, likes to move with this herd mentality. So I do think that some of these issues that have cropped up were unfortunately timed. I do think SVB might have been able to get around this if the timing of, say, the withdrawals had been a little bit better. But yeah, I mean, just chaos, right? I guess is the only thing you could really say at the end of all this.
And I want to follow up on what Dom said in our conversation on the open. What caused this problem was a year ago, Treasury securities were 2, 3, 4% lower. And the banks were buying these, which was a prudent thing at the time, right? They buy Treasury securities, safest investment you could buy. And then when interest rates spiked up so rapidly, these banks got caught flat-footed with these lower interest rates. And this is economics 101. Interest rates go up, bond values go down. So in your opinion, and Dom said if we had, J.P. Morgan running the ship, this maybe never have happened. But wasn't it incumbent upon these, people buying these bond portfolios to kind of hedge against this and lighten up on these bonds that they were getting clobbered on?
Yeah, and I think that is an important distinction to draw between Silicon Valley Bank and basically any other major financial institution out there right now. I mean, to your point, Mike, right? A lot of banks, in fact, most banks own a lot of this paper, and yet you are not seeing the same sort of volatility that you did see in SVB. And I think you can account for that for two different reasons. One of them, to your point, is that it seems like Silicon Valley Bank didn't do a whole lot to hedge their interest rate risk. And while clearly the Fed raised rates, I think, faster than anybody could have expected. We all knew rates were going up a year or two ago. We all knew that was going to happen. We all knew that 0% on the Fed funds rate was not sustainable forever. So to not have any sort of hedge in place to protect against that it feels a little bit irresponsible. But we also have to remember that the business model of this bank looked very different from the business models of most traditional banks, right? The way that banks make money at the end of the day is borrowing from you, the depositor, at a low rate and then lending out that money at a higher rate, whether that means buying securities or issuing mortgages, credit cards, auto loans, that sort of thing. But the nature of Silicon Valley Bank, and Dom, you mentioned this earlier in some of your comments, is that because they dealt with these more tech-focused individuals, there's a lot of money piling in, but those businesses, not individuals, businesses, I should say, are using that money to fund things like payrolls, to fund things like operations. So Silicon Valley Bank had to take excess risk, where they felt like they had to take a little bit of excess risk in order to sort of improve their profitability model, because you can't make a whole lot of money with a lot of deposits, but not a big loan book. And so you take those two things, right? The lack of the hedge, and then also the sort of business model intrinsic to the institution, and it helps to show why this company really got caught off guard, whereas it seems like contagion risk has not really spread too much, especially to the bigger financial players in the country.
And Jack, I just want to stress a point you made, that every bank in the country is running a bond portfolio. Every insurance company in the country is running a bond portfolio. We won't even talk about pension funds and institutional money managers who did not see this one coming. Right? I joke about even I could have figured this one out, but I think we could have figured it out, right, Mike?
Oh, you
I want to go. I think we did.
Well, look, and in spite of the fact that interest rates went up very rapidly, it still was over a year. It's not like they went up 500 basis points in 2 weeks, right? You still have time to maneuver. Jack, I guess the other thing that I'm grateful for is I remember, like yesterday, the 2008 financial crisis. And I remember watching the vote in Congress that the first TARP proposal was voted down. I remember watching in real time the stock market going down like 3,000 points, as you could see the vote wasn't going anywhere. And I think it was a blessing that they were able to do something over the weekend without needing bipartisan votes, not getting too many politicians involved. They just made a decision. They were able to act on it. Because again, if I think they weren't able to act that quickly, we would be having a much different conversation.
I completely agree. I mean, if you want to take sort of a glass half full attitude about anything that's happened over the last even 2-3 years, it's that we've learned a whole lot of lessons about how to manage crises effectively. Whether we did it the right way or we did it the wrong way, we are learning lessons on how to deal with these things. And I think the theme that you've been seeing out of the federal government, out of even the Federal Reserve, has been a swiftness of action. This idea that whatever we're going to do it quickly. We're not going to sit around and wait and twiddle our thumbs and wait for whatever the next step may be. We're going to take action now. We're going to see what happens in the future. And for the most part, I think that has been a prudent way of handling things.
So, Jack, one of the maybe unintended consequences is we actually saw the 10-year yield drop pretty dramatically, right? And even the short-term 2-year interest rates fallen back pretty dramatically. There was a mad rush for people to buy safety, and this seems as safe as it gets. Maybe this helps other institutions?
I think that could be a way to interpret it. Sure. I mean, like you said, Dom, the 2-year, I think it had its biggest single move since Black Monday in 1987. I mean, these are really not necessarily record-breaking moves, but they are moves that will make the history books, certainly. The most interesting thing, I think, if you're looking at the yield curve right now and looking at sort of expectations for interest rates moving forward, is that the expectation for the terminal Fed funds rate at the end of this year shot down about 100 basis points in a couple of minutes. I mean, that's incredible. We went from looking for 125 basis points to go this year to around 25 basis points to go this year. And in fact, at one point yesterday, the futures market was pricing in cuts by the end of this year. I mean, that is extraordinary.
Over an insanely short period of time.
A short period of time, a massive move, and a fundamental break from everything that we have been talking about up until this point. And so you can think, sure, Dom, to your point, given what's gone on with rates, I'm sure there are certain businesses that may benefit from lower costs of borrowing. There are certain individuals that may benefit from their APRs being pegged down to a lower level. But I think ultimately, again, you want to have a glass half full view about this kind of thing. It is probably good news for particularly stock investors that are looking for that light at the end of the tunnel when it comes to Fed policy and when exactly we're going to see terminal Fed funds achieved.
So Jack, we're bumping up against a break, and when we come back from the break, we want to talk about other things than the last 4 days. But in your opinion, do you feel, it sounds like you do, that for the moment this thing has been kind of isolated and under control at the moment?
At the moment, I do. It is still far too early to make a firm judgment call on this kind of thing, and it almost feels irresponsible to say the coast is clear because when you say that, it won't be. So I'm not trying to jinx anything now. But in terms of what the government response to what happened could have looked like, I think this is about as good as it could have been. And it should be very, very reassuring to those individuals and businesses that have deposits over that $250,000 insurance threshold at the FDIC. They don't need to pull their money out. They don't need to go somewhere else, even if it means a money market fund. They can stay where they are. And so bank runs, I think, are likely going to be prevented.
So to your point, God forbid if it's a third bank, the government's basically said that this is what they're going to do for the time being if a third or fourth or fifth bank comes along with the same predicament.
If it's the same predicament, yes. If it's a bunch of bad loans gone south, like what you would have seen in 2008, it's a completely different story. But if you have, $100 billion of high quality securities on your portfolio that you can't sell because par value has just gotten destroyed, you now have this lender of last resort that will step in and help to prop up your business.
All right. Well, on that note, let's take a quick break and we'll be back in a few minutes with Jack Manley from J.P. Morgan Asset Management. All right. I'm Michael Hartzman, back with my partner, Dominic Tavella, and our guest this evening, Jack Manley, Vice President and Global Market Strategist at J.P. Morgan Asset Management. So, Jack, this morning we got the CPI reading, otherwise known as the Consumer Price Index, which is basically the benchmark of how the entire economy is doing, correct?
That's right.
As it relates to inflation. And the number came in as expected. And the markets had a pretty good day. You could attribute that to a bounce back from the last several weeks and days. You could attribute it to, a sigh of relief. Or do you attribute that to that this print today now gives the Fed a little cover to not raise interest rates as expected next week, which would potentially do more harm to other smaller banks?
Yeah, Mike, I guess what I'd say to that is before the bank blow up over the weekend, today's CPI print would have been the most important thing for us to be looking at as investors, because to your point, it is sort of the barometer that we've been using to assess the overall strength of the economy going back 24 months at this point. CPI is the only thing that we've been really paying attention to, because ultimately, as you said, inflation is what's feeding through into Fed policy. And the sooner inflation comes down, the sooner the Fed can stop tightening. But as I said, right, that was up until we start to see this sort of genesis of a banking crisis over the weekend. And now I don't think the CPI print this morning is particularly important. And when we think about what happened with inflation today, as you said, kind of more or less right in line with what we were expecting, 6.0% on that headline growth figure. That is down pretty significantly, 0.4 of a point relative to where we were in January, which in turn is down relative to December. And in fact, is now the 8th consecutive print that we have seen of disinflation, right? June of last year still represents the high water mark. We also saw core CPI, which is CPI removing the more volatile sort of commodities like food and energy, move lower, this time to about 5.5%. Again, more or less in line with expectations. I think, given the issues that we are seeing with the financial system, given the concern that investors and policymakers have right now about the unintended consequences of high rates, as we discussed earlier, you would have had to see just an absolute monster of a miss on the CPI print this morning to fundamentally change the Fed's trajectory next week. So, does CPI matter? Of course it matters, but it is now, I think, a secondary concern relative to what happened over the weekend and the overall stability of the financial system.
So, Jack, I mentioned earlier that the lower interest rate environment might help some institutions, but myself, Mike, we've gotten tons of phone calls today, very concerned clients. I don't know that they're completely off the ledge just yet, but I bet you they're going to slow down on their spending. I bet you they're going to hold on to their dollars a little bit tighter and be a little bit more careful about how they get those dollars out of the economy, which that in itself might help inflation. What are your thoughts on that?
I mean, that like you said, Dom, that very could easily help inflation, right? Because the traditional side of thinking about inflation, at least when it relates to demand-related inflation, is that it is too much money chasing too few goods, right? That's sort of the nature of inflation. And if you go from too much money to just the right amount of money chasing, whatever the right amount of goods may be, you are going to see prices get reined in. And so that could be good from an inflation perspective, which in turn could be good from a Fed policy perspective. The other side of this, though, I would say, is that consumption represents about 68-70% of all U.S. GDP. So if the consumer, starts to tap on the brakes and thinks about slamming on the brakes right now because they are apprehensive or nervous about current conditions with what happened over the weekend, kind of amplifying those fears, a slowdown in consumption that is prolonged and is deep is typically going to result in a recession. And when we think about the sort of Goldilocks scenario here, it is this idea that inflation settles back down to something more comfortable while avoiding a recession. That's the soft landing that we're looking for. So if we do see inflation come lower to avoid that recession, I don't think it can come from a collapse in consumption. So I'm not necessarily rooting for that, even though it would be good for CPI.
So Jack, let's do a little economics 101. Because when I talk to clients, when Dom talks to clients, we always try to put these things into context. And we always start the conversation with, well, the reason we're going through this is because the economy is too strong. Right? And then I hear there's this dead silence on the phone, and these people are wondering, is my financial advisor a lunatic? Is he an idiot? But the truth is, we're going through this because the economy has been stubborn and not cooling off. Dominic said, consumers are going to probably start to spend a little less, and I agree with him. But just try to, shed a little light on that. Like, why are we even going through this? Why are we going through these machinations of raising interest rates and worrying about inflation?
I mean, so you're right in the sense that the economy, I think, has held in a lot better than anybody would have expected, given where rates are right now and how quickly they got there. And the best way to, I think, sort of evidence that is by looking at the labor market reports. Look at what's going on with payroll gains. Look at what's going on with the participation rate. Look at what's going on with the unemployment rate. The unemployment rate this past Friday moved up to 3.6%. Before that, in January, it was 3.4%. That was the lowest unemployment rate we've seen since 1969. Evidence, right? Exactly to your point, Mike, that this economy was really holding in there. Now, why we think, why are we concerned about inflation? Why is that an issue? Well, inflation at a certain level, and it's hard to quantify what that level is, but at a certain level, inflation becomes a self-fulfilling prophecy. Because let's pretend, for example, let's use a round number 10%. And say that every single thing that you can buy there, whether it is a good or a service, an airline ticket or a dozen eggs, is increasing by that same rate, right? The price of that is going to increase by 10%. Now, if you know that the price of eggs is going to be 10% more tomorrow, are you going to wait until tomorrow to buy them, or are you going to buy them today? You're going to buy them today. So elevated inflation pulls forward demand. And what happens if you and Dom and me and everybody on the line is looking at those same numbers, and we all realize, hey, eggs are going to be 10% more expensive tomorrow than they were today, because today they're 10% more expensive than they were yesterday. Well, then we all go to the store and we all try to buy those eggs. And then you're back to this classic story of too much money chasing too few goods. And so inflation has become a self-fulfilling prophecy. Those prices are going to rise because we all tried to beat out the rising prices. That's the way it works. So the Federal Reserve steps in and tries to raise interest rates to make the cost of borrowing increase. So it is harder for us to spend so that consumption falls down. And when consumption falls down and we're more careful about how we are sort of allocating our capital, prices are allowed to at least rise more softly, if not outright fall, right? And when we see prices rising softly, that's disinflation. When we see prices fall, that's what we refer to as deflation. But inflation's been really tricky these last 24 months. We think about particularly what was happening 12 months ago. Inflation was mostly supply driven. We're talking about Russia having just invaded Ukraine, two very large producers and exporters of commodity products, hard to get a hold of food, hard to get a hold of fuel. If we had had this conversation 12 months ago, we would have been talking about China, which would have still been under a strict zero COVID tolerance policy, which is gumming up the works when it comes to industrial production, makes it hard to get a hold of any sort of finished goods. Vehicle prices are what kind of bubbled up to the surface on that one. It was supply related inflation. And you know what the problem is with that? Interest rates don't fix that. The Fed can't fix that. Jay Powell cannot end the war in Ukraine. Jay Powell cannot change Xi Jinping's mind about COVID policy. These things are outside of the scope of monetary policy, and yet rates kept rising. But what's interesting is that if you look at CPI nowadays, it's not so much about food or fuel or vehicles or goods. It's about services, things like restaurants, things like hotels, leisure, hospitality. It is also about shelter costs. And that is demand related, and that the Fed can influence. And so that's why we continue to see upward pressure on interest rates. And that's why, frankly, we're in this mess, right? Because the Fed has been fighting against very sticky, unpleasant inflation, and it knows it needs to get it back down to a level that is more comfortable.
Just to change the subject a little bit, we started the year, and I won't name them out loud, but a major firm, Wall Street firm, talked about earnings for the S&P somewhere around $230, $235. Seems like we've been losing about $1 a week in those projected earnings. Nowadays, $218, $220. Are we going to go through an earnings recession?
It's possible. When it comes to the outlook for earnings, you have to have an outlook on any sort of potential slowdown or perhaps a recession. Because when I think about what's gone on with earnings over the last couple of years, 2021 was a blockbuster year for corporate profits because margins just blew up, right? The cost of doing business was a lot cheaper post-COVID because business, offices are shut down, meetings are happening over Zoom, and people just aren't spending as much as they used to, and so margins are improved. You fast forward and you look at 2022, and margins went from expanding pretty significantly to actually contracting pretty significantly and being a net drag on earnings last year. The world is reopened. It costs more money to do business. And on top of that, rates are higher than they were a year back. Wages are higher than they were a year back. Supply chain issues mean that input costs have risen to a point that's higher than where it was a year back. So that sort of set the stage right now for 2023, where margins have already compressed a lot from where they were in 2021. And I would argue that a lot of those forces that push down on margins are starting to abate, right? The Fed may keep raising rates. I hope not, but they may continue to raise rates. But look, we're not going to get another 5% added to the Fed funds rate. We're talking about 25 basis points, maybe. So there's a light at the end of the tunnel for that. Wage pressure is still rising, but at a slower level. Supply chain issues have sort of resolved themselves. The reopening story is largely behind us. All this means that what you got to pay attention to for earnings this year, I think, is top line growth. It's revenues, it's sales. And if you want a view on revenues, sales, you have to have a view on the overall health of the economy and the health of the consumer. Now, we've talked when we're speaking to clients about what's going on with the economy. I think it is always important to point out, Mike, to your point, that there is a lot of resiliency here, that we continue to add jobs, that people are still paid. I think it's important to point out that there are no obvious imbalances in this economy. The housing market's not out of whack like it was in 2008 as an example. And so if you do get a recession, I think it's going to be a pretty mild one. So my view on earnings this year, it's not great, sure, but it is not for a massive contraction that some other shops on the street are looking for. I think the economy holds up reasonably well, just given all this excess demand for labor that's out there and what that's done to our labor market.
So, to your comment that if we do have a recession, it'll be a mild one, just remind our listeners, a recession is measured in time. So you would think, it would be just a couple of quarters and we could just get in and out of any potential recession. Is that what the hope is?
So a recession is going to be measured in time, but it will also be measured in severity. When we think about what happened in the first half of last year, we got 2 consecutive quarters of negative GDP growth. That, historically speaking, has been kind of a bellwether for a recession, but it is not the technical definition of a recession. It's just a quick, easy back of the envelope way to calculate it. What we want to look for instead is there's an organization called the NBER, the National Bureau of Economic Research. Think of them as kind of the referees for the U.S. economy. They've been doing this for about 100 years at this point. They look for sustained, prolonged contractions across a number of different sectors within the economy. That could be real personal incomes, it could be retail sales, it could be industrial production, it could be payroll employment. So you're not just looking for the time of the drop, but you are also looking for the severity of the drop. And I think one good example of that is the COVID recession, right? I mean, we obviously had a recession in 2020, but if you think about the nature of that recession, the recession probably started in, call it April, and probably ended in early June. If that had been shifted forward 2 months, that would have been a 1-quarter contraction, not a contraction spread out over 2 quarters. You still would have called it a recession. So yes, Mike, there's a roundabout way of answering your question. I think it's going to be a pretty shallow recession, not a massive collapse in economic activity, but also probably one that's on the shorter side.
Jack, we're starting to run a little bit towards the end of our show here, but one point that we brought up earlier, these higher rates, I'm getting a lot of calls from clients who have adjustable rate loans who for years almost ignored them because the interest rate was so low. It's like, why even bother to pay them back? And clearly there's a lot of corporations out there that borrowed excruciatingly low rates. And now all of a sudden they need to either refinance those bonds, or they have adjustable rate loans that they also, your final thoughts on higher interest rates and their effect on the economy?
So higher rates are going to be here for a little while longer, but I do think it is possible, especially given that the Fed may be changing course in light of what's gone on over the weekend, that we've hit a high watermark in terms of interest rates. I think it is also important to point out here that the Fed itself has told us that whatever the Fed funds rate is at the end of this year will not be the Fed funds rate forever. It has told us explicitly that we will be seeing rate cuts next year, that we will be seeing rate cuts in 2025, that the long-term terminal Fed funds rate is going to be a lot lower than where it is right now. So the question is, how are you able to kind of make it through this short-term pain? And I would say, since we are closer to the end of this hiking cycle than we are to the beginning, the worst is largely behind us. We'll touch wood on that one proverbially and say that, look, if you made it so far, you're probably going to be okay. So I think the economy is able to digest the impact of these higher rates and will benefit as they drift lower.
So Jack, one last question for me. So do you also think that the yield curve inversion is finally going to break, where the 2 and the 10 will go back into its normal rotation?
It's going to take an awful lot for that curve to sort of uninvert itself, honestly, just because the short end of that curve is so high. You give it 2 or 3 years, I could see a yield curve that is shaped more appropriately. But when you're looking at a Fed funds rate of 5%, 5.25%, I don't see the 10-year getting there anytime soon. I think it's going to take a lot to get there. So an inverted curve, I think we're going to be living with for at least another 12 months.
But unlikely we'll see the 1 year or the 9 month paying 5%. I mean, that dropped like a rock, as we said earlier in the show.
Hey, let's see what happens next week. That's going to influence a lot of our view on what may happen with that shorter duration paper. It's at this point, honestly, anything's possible. I don't think we should think about the Fed as a rational actor. I think they've acted sort of irrationally over the last 13, 14 months. So no matter how reasonable your view may be, you can't necessarily count on it.
Understood. Jack, we are out of time, and we appreciate you putting some common sense on a pretty complicated topic.
Thanks for having me, guys. It was a lot of fun.
Thanks for joining us, Jack. We look forward to having you back. You did a great job of explaining this to us and our clients.
Thank you.
We'll be right back.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with a quick close with Dominic. Dom, as Jack was speaking, I kept thinking of the expression, if you break it, you buy it, because we kept waiting. We kept knowing that eventually something was going to break, right? That the Fed was raising interest rates and there was going to be some damage done. And literally they broke it and then they protected all the depositors. So they broke it and then they bought it. You know, they I know it's not that simple, but that's what I kept thinking.
Yeah, Mike, we all expected something to break.
Right.
And we touched on a couple of those when we talked about the consumer now with the rising interest rates. We talked about companies with borrowing costs that would go higher, and obviously that would affect their margins and their profits. We didn't really expect the bank to not, and I'm not here to point fingers, but maybe not do a great job of managing their portfolio. That one caught the market by surprise. And as ugly as Friday was and the weekend was stressful, I'm grateful that they resolved it pretty quick.
Look, I mean, to your point, we knew rising interest rates this has been happening for a year. We've had many analysts on the show. We just talked about amongst ourselves what sectors do well in a rising rate environment. And what's always the first or second category gets mentioned is financials.
And we thought that financials will actually behave well this year. Fortuitously, we cut our exposures dramatically way before this happened for a multitude of reasons having nothing to do with banks themselves. But they should be performing well in this environment in that they also will be earning higher interest rates. And this clearly threw a whole monkey wrench into the sector.
Yeah, and that's what the complicated part of all this was all about, right? You know, you hear the expression "a run on the bank," you know, and you think of It's a Wonderful Life and, you know, Mr. Potter standing at the door, but this was literally a modern day run on the bank.
It absolutely was, Mike. I think I shared a number earlier where they had some 40, almost $50 billion of withdrawals over a 2-day period. It's unsustainable. Maybe one of the large commercial banks here in the States could have handled something that large, but not a regional bank, not a bank. And this was the 16th largest bank in the country, but it was unsustainable. And frankly, the whole thing was unnecessary. But I think this is where you can give them an attaboy to the FDIC and the government stepping in and doing the right thing.
Yeah, and I'm glad I asked Jack if God forbid there's a third, fourth, or fifth bank, is the FDIC and the government going to take the same position? He said they would. Not that we want that to happen, obviously, but I think it's that perception where the government didn't say, "Oh, we're making an exception today for these two institutions," because that still could have caused a run on a third or fourth or fifth bank. And as you could see today, a lot of those regional banks really bounced back nicely.
Yeah, they had a really strong day. And I imagine it would have taken some courage today to jump into that shark-infested waters. But if you did first thing in the morning, you could have had a really good day in just one day. Now, again, not the kind of risks that we would take in our client portfolios, but the sector overall, I don't think deserved the abuse it got. And I think obviously some volatility with the Fed making an interest rate decision shortly, but I still think it's a good sector longer term.
So Dom, the Fed's meeting Monday and Tuesday, correct?
I think it's early next week. It might be Tuesday, Wednesday. I'm not sure, Mike.
Whatever it is, it'll be that the second day of the meeting at 2 p.m. is when the world
Correct.
stops.
Yeah,
and they make their announcement. It'd be really interesting. Jack said maybe 25, maybe nothing. Goldman Sachs went on the record saying maybe nothing. Be really interesting if they did that.
We always talk about headline risk and such. How will the markets react? And you would think it'd be extraordinarily positive if they went nothing. But there's part of me that says, wow, is the market going to interpret that as that the Fed's lost control? And maybe they should do 25 and pause, right? But we'll see. We'll see how the markets react.
So, Dom, we are out of time.
Unbelievably.
This was a lively show tonight. We had a lot to go over.
Terrific guest.
Yeah, he was great. He was awesome. We want to thank J.P. Morgan Asset Management. He's the third guest we've gotten from them in the last 5 weeks. So we're very grateful. And I will see you down the road, my friend.
Traveling as always, but hopefully on every Tuesday night with you, Mike.
Have a good night, everybody.
Good night, all.